Hello, beautiful minds, and welcome back to Boni's Life, the channel where we navigate the beautiful, chaotic, and often downright hilarious world of financial markets. If you're feeling a bit of whiplash from the crypto market this past week, you're not alone. It was a roller coaster that would make most theme parks look like a leisurely stroll in the park. We saw a new all-time high for Bitcoin, followed by what can only be described as a history-making nosedive. So, what on earth happened? And more importantly, what's coming next? Well, you've come to the right place. In today's episode, we're going to dissect the past week's technical tsunami, look ahead at a calendar packed with market-moving catalysts, and arm you with the fundamental insights and trading strategies you need to conquer the week ahead. We'll hear from the big guns, the institutional players, the expert analysts, and even the regulators who are finally starting to change their tune. By the end of this, you'll be more prepared than a squirrel in autumn. So grab your coffee, settle in, and let's make some sense of this madness. All right, let's get right into it. The past week in crypto was a classic tale of two cities. It was the best of times, it was the worst of times. We started the week with euphoric highs, with Bitcoin smashing through its previous records to touch over $125,000. The champagne was flowing, the memes were glorious, and it felt like the bull run was unstoppable. And then Friday happened. In a move that sent shockwaves across all risk assets, President Trump announced a new 100% tariff on Chinese imports and new software export controls. The market's reaction was, well, less than thrilled. What followed was described by data tracker CoinGlass as the largest liquidation event in crypto history. Let's look at the numbers because they are staggering. In just 24 hours, over $19 billion in leveraged positions were wiped out. That's billion with AB. Over 1.6 million traders were liquidated. At one point on Friday, we saw $7 billion in positions vanish in less than an hour. Bitcoin plummeted over 12%, dropping from its shiny new all-time high to a low of around $102,000. Ethereum and other major altcoins didn't fare any better, with some dropping 20 to 25%. As Joshua Duckett, a director at a crypto forensics firm, put it, this was a classic case of cascading liquidations. He said, and I quote, "People can borrow against what they have and leverage up to extreme amounts 100 times essentially in crypto. This caused a spiral of cascading liquidations. It's a stark reminder that leverage is a double-edged sword, and when the market turns, it can be brutal. The crypto market, being the 24/7 beast that it is, reacted far more violently than the traditional stock market. From a technical standpoint, this crash was a major test of key support levels. Bitcoin found some footing around the $110,000 mark, and as of this recording, it's hovering around $111,600. But the big scary number that analysts are watching is $100,000. Caroline Moron, the co-founder of Orbit Markets, warned that a break below $100,000 would signal the end of the past 3-year bull cycle. No pressure, right? The options market is reflecting this anxiety. With a high concentration of put options at the $110,000 and $100,000 strike prices, it's like the market is holding its breath, waiting to see if the floor will hold. So, after a week like that, what does the week of October 13th have in store for us? Well, it's not going to be a quiet one. We have a packed economic calendar, and several key events could inject even more volatility into the market. Let's pull up the calendar and break it down. First up, on Monday, October 13th, we have a few public holidays, including Columbus Day in the US and Thanksgiving in Canada, which might mean thinner trading volumes early in the week. But the real action starts with China's trade data. We'll be watching their export and import growth figures closely. Any signs of a significant slowdown could reignite fears about the global economy and the trade war, which, as we just saw, is not great news for crypto. Tuesday is a big day for the UK and Europe. We get UK employment data and German inflation figures. More importantly, the Reserve Bank of Australia is releasing its meeting minutes. The RBA's tone on monetary policy will be a key indicator of risk sentiment for the broader markets. We also have speeches from ECB and FED officials, so traders will be passing every word for clues about future policy. But the main events are concentrated on Wednesday and Thursday, with a whopping 62 and 102 economic events scheduled respectively. These are the days to be extra vigilant. We'll be seeing a flood of data on everything from inflation to industrial production from major economies. And here's a crucial one for the crypto world. On Wednesday, October 15th, Morgan Stanley officially opens the floodgates. They are dropping all restrictions on crypto fund investments for their wealth management clients. We're talking about a firm with $8.2 trillion in client assets. This is a massive step in institutional adoption and could bring a significant wave of new capital into the market. We'll be watching to see if this provides a much-needed tailwind for prices. Finally, the week will be peppered with speeches from various central bankers. Keep an eye on any comments about inflation, economic growth, and their outlook on monetary policy. In this nervous market, a single hawkish or dovish comment can send prices flying in either direction. Now, let's zoom out from the daily charts and look at the bigger picture. Despite the recent carnage, the fundamental case for crypto, particularly Bitcoin, is arguably getting stronger. First, let's talk about the Federal Reserve. The Fed has pivoted to a more dovish stance, cutting rates by 25 basis points in September. The market is widely expecting another cut at their meeting on October 28th. This, combined with a weakening US dollar, which recently hit a 12-month low against the euro, creates a very favorable environment for assets like Bitcoin. When the purchasing power of fiat currency is declining, investors naturally look for a hedge, and Bitcoin is increasingly being seen as digital gold. And speaking of gold, JP Morgan analysts recently made a bold call. They project a theoretical price of $165,000 for Bitcoin by the end of 2025, arguing that it's undervalued compared to gold on a volatility-adjusted basis. That's a significant upside from where we are now. Then there's the institutional adoption story, which is only accelerating. The State Street survey of institutional investors was incredibly bullish. It found that 60% plan to increase their crypto allocation in the coming year, with the average portfolio allocation expected to more than double from 7% to 16% by 2028. This isn't just retail speculation anymore. The big money is here, and they're planning to stay. The Morgan Stanley news is a perfect example of this. Their chief investment officer, Lisa Chalette, called cryptocurrency a speculative and increasingly popular asset class that many investors, but not all, will seek to explore. That's a far cry from the dismissive tone we heard from Wall Street just a few years ago. And let's not forget the historical context. We are in October, after all. Economist Timothy Peterson pointed out that since 2013, October has been Bitcoin's second best performing month, with an average gain of 20.1%. He even noted that sharp drops of more than 5% in October are rare, and when they do happen, they are often followed by a strong rally. If history is any guide, this dip could be a massive buying opportunity. As the ever-bullish Samson Mow of January 3rd reminded everyone on X, there are still 21 days left in October. Even the regulatory landscape is looking brighter. The SEC has approved new listing standards for crypto ETPs and is talking about a sweeping overhaul of regulations. This regulatory clarity is crucial for attracting more conservative institutional capital. So while the short-term price action is scary, the long-term fundamental drivers are lining up for a potentially explosive move to the upside. As trader Michael van de Poppe put it, this latest dip could be the bottom of the current cycle. Alright, this is the part you've been waiting for. We've analyzed the past, looked at the future, and understood the fundamentals. Now, how do we trade this market? I'm going to lay out a few strategies for the week ahead, but please remember this is not financial advice. Always do your own research and manage your risk. First, let's talk about Bitcoin. The key levels to watch are the support zone between $110,000 and $112,000 and the critical support at $100,000. On the upside, we have resistance at $114,800, $124,000, and then $130,000. Strategy 1. The conservative accumulator. If you're bullish long-term but cautious about the short-term volatility, you could consider scaling into a position in the support zone, an entry between $110,000 and $112,000, with a stop loss below $108,000 could offer a good risk-reward ratio. Your first take-profit target would be around $118,000, with a second target at $122,000. Strategy 2, the aggressive breakout trader. For those with a higher risk appetite, you could watch for a confirmed breakout above the $114,800 resistance level. This would confirm the inverse head and shoulders pattern we're seeing on the 4-hour chart. An entry on a strong volume breakout with a stop loss below $112,000 could target the $124,000 resistance level and potentially higher. Strategy 3, the Ethereum catch-up. Ethereum has been lagging behind Bitcoin recently. If you believe in the broader market recovery, ETH could offer a higher beta play. An entry in the $3,700 to $3,850 range with a stop loss below $3,600 could target the psychological resistance at $4,200 and then the technical target of $4,500. Strategy 4, the long-term hodler. If you're a long-term believer, this volatility is just noise. Dollar cost averaging is your friend. You could consider allocating a portion of your intended investment at current levels, and then add to your position if we see further dips to $108,000, $105,000, or even the critical $100,000 level. Now, a word on risk management. This is non-negotiable. Always use a stop loss, never risk more than you can afford to lose, and be mindful of your position size. In a volatile market like this, it's wise to reduce your usual size. And remember, crypto trades 24/7, so be prepared for weekend shenanigans. And that's a wrap for this week's Crypto Deep Dive. It's a market of high drama, but also of incredible opportunity. We have a confluence of bullish long-term fundamentals, a historically strong month for Bitcoin, and a market that has just flushed out a massive amount of leverage. But the short-term risks are real, with a packed economic calendar and the lingering threat of geopolitical tensions. So trade smart, stay informed, and don't let the volatility shake you out of a good position. What are your thoughts on the week ahead? Are you buying the dip or waiting for more confirmation? Let me know in the comments below. I read every single one. If you found this analysis helpful, do me a favor and smash that like button, subscribe to Boni's Life, and hit the notification bell so you never miss an episode. Until next time, stay curious, stay profitable, and I'll see you in the next one.